Instead, if you invest where others aren't, which again, very few people are investing in mid-cap, you get lower valuations because people are not driving those prices up, which implies higher potential upside and a margin of safety. So higher return, lower risk.
Welcome to Lead Leg Live. I'm your host, Melanie Schaefer. Right now, investors are grappling with a strange split in sentiment. There's plenty of discomfort and uncertainty about the economy, yet money continues to pour into momentum and passive strategies, even with valuations running higher than we saw during the tech bubble. It's exactly the kind of environment where portfolio construction decisions can make or break returns. My guest today is Seth Cogswell, founding partner and portfolio manager at Running Oak. Running Oak's approach focuses on equal weighting, mid-cap opportunity, and a disciplined process designed to avoid the pitfalls of overconcentration that come with traditional cap-weighted indexes. Seth, thanks for joining me today.
Thank you for having me. I love that intro. Thank
you. So, Seth, to start out really broadly, what topic is sort of most on your mind right now?
Really, you just summed it up. I feel that there is a pervasive feeling of discomfort and uncertainty that everyone feels, and yet they're investing in precisely the opposite manner. And so there's this contradiction. And I want people to trust that feeling that they have and that unease. Running Oak, our strategy is simple, common sense. We invest in three very obvious principles. So maximize earnings growth, because nothing drives performance like a company making more and more money, while being disciplined around valuations, because the last thing you want to do is own assets that should go down over the long run. That's worked out for a little bit recently, but over the long run, that is not a good exercise. And then lastly, an overarching focus on a handful of simple, but again, obvious metrics or qualities that clearly lead to greater downside risk. Nothing kills exponential growth like big drawdowns, and that's why we're all doing this. And so avoiding that's extremely important. Our strategy, that simplicity, gives me certainty and hopefully gives our clients certainty, not necessarily in the outcome, but certainly as far as the qualities that we're investing in and knowing that we are thoughtfully investing in ways that make sense. Meanwhile, on the flip side, people are now all in in an uncertain world. They're effectively all in on certainty. Investing is inherently uncertain. Even if you stack the odds in your favor by doing a whole lot of research and investing in a company that you think is highly likely to work out, keywords there are highly likely. There's a chance it doesn't. And the economy or the world feels wildly uncertain, and many people feel that. Investing is basically a sort of a derivative of the real world, right? It reflects what's happening in the real world. So you take an uncertain world that everybody feels and senses, and then you compound that with the uncertainty of investing, and it's somewhat doubly uncertain. Meanwhile, recent numbers came out where households have more money invested in equities as far as a percentage of their net worth, 20 to 30% more than they did at the tech bubble. So they're somewhat all in on equities. At the same time, according to certain numbers, over 50% of equity assets are now in passive portfolios or index funds, a lot of which people aren't necessarily thinking about the risks that they're taking. And passive has been it's had a very positive impact on the investing world and on investors, certainly relative to what was in the past as far as active management charging 2.5% while providing no value whatsoever in closet benchmarking. It's been a positive evolution, but that doesn't mean that it's the final evolution. What many miss is passive at its heart, or we'll say cap weighting construction, is inherently nonsensical. If let's say hypothetically, we start out with a company that is fairly valued, because historically there's been a belief that markets are efficient. So we start with a company that is fairly valued, and that fair valuation reflects a percentage of the S&P 500. So that market capitalization that's related to that fair value results in a percentage that's allocated. And let's say everything else is perfectly allocated at this one moment. Then, because people are trading, buying and selling stocks all day, every day, someone comes in and buys it. That will push it up, because that's what happens. Demand pushes the price up. Now, that company, despite nothing changing, fundamentals haven't changed at all, the company is now valued more highly, which means it receives a higher percentage of the S&P 500. If you extrapolate that over the course of 16 years in the highest period of momentum ever, what you get as momentum investing is effectively something was up, so I'm going to buy more of it. Then it's up, and so someone buys more of it. And you get this feedback loop. You do that for 16 years. Now, all of a sudden, you are massively overweight, overvalued companies and underweight, undervalued companies. Just by definition, that is the way that passive investing or cap weighting is constructed. You will always have more invested in overweight companies or overvalued companies because they're overvalued. And you will be underweight what they should be, undervalued companies, because they're undervalued. And the issue with that is, again, if you think of momentum, you buy because it was up yesterday. And people buy yesterday because it was up the day before. And extrapolate that over 16 years. And if everybody is all in, or I shouldn't say everybody, but if over 50% of equity assets are now invested in cap-weighted portfolios or index funds, it expresses certainty. People are all in, expressing certainty in a wildly uncertain environment, and making a bet that what happened last year or what happened over the last 15 years will continue to happen. Maybe it does. But last year, momentum hit the 99.8th percentile in history. That is a 1 in 500 event. So if you're all in on cap weighting or index funds, or even the Mag 7, because there's such a massive percentage of index funds, you are investing with certainty when almost everybody feels incredibly uncertain and uncomfortable. And so it's really that juxtaposition between how people feel, and I think how people kind of at least inherently know the world is right now, and how they're investing. And I would like people to listen to not necessarily their brains, but I guess maybe their souls a little bit more, and actually trust themselves, as opposed to just trusting those who tell you that the market will always be up over the long run. Because that is wildly misleading. It may be, and it probably will be over the very long run, but that doesn't mean it will be in the next few years.
It's a really excellent explanation of the current state of the market. And as you mentioned, and I did, Running Oak's portfolio is equally weighted. Why equal weighting versus alternatives?
On one hand, you can invest, you can allocate the same portfolio in a number of different ways. Some will add value, some others won't. Equal weighting puts mean reversion in your favor. So again, I feel the world's uncertain. Investing is uncertain. People are buying and selling every day, which creates noise and volatility. And if you have noise and volatility, equal weighting puts that in your favor, because as a stock has popped up for whatever reason, an equal weighting portfolio will sell that. If a stock is knocked down or lags for whatever reason, equal weighting will add to that. And so if the market's noisy and volatile, that will actually add value. Again, there's times where cap weighting adds value. If momentum is especially hot and you get this feedback loop where everything that went up yesterday is up again today, great. Cap weighting will do well. But that assumes that it's going to go up, that these overvalued stocks will go up forever into perpetuity. Again, equal weighting is a great way to express uncertainty, because again, it takes advantage of that noise, but also it adds diversification. Today, more is invested in the top 10 companies in the S&P than any time in history. That's paid a lot of lip service, and we're inundated with data and the same sound bites all the time. And so we tend to check out, but it's worth taking a second and just really think about that, right? Whether it's advisors investing on behalf of clients, whether it's clients, people's net worth that they have worked so hard to build is massively invested in a small number of companies that are arguably highly correlated. They're all big tech. And that expresses, again, certainty. Whereas equal weighting, you might have, let's say if you have 50 companies, now you have 2% invested in each one. That expresses uncertainty. And it's an alternative way to invest. It puts the odds in your favor over the long run. Another good point is, prior to this last decade, equal weighting had outperformed cap weighting over every single rolling decade. Every single one. It's only the last 10 to 12 years when we've been in this sort of momentum machine driven by a number of things, passive, all the stimulus, what have you. But equal weighting was always the way to go. The one exception is right now or recently. And so the question is, are you going to bet against history, or are you going to bet on uncertainty and history?
Yeah, and I wanted to talk a little bit about RSP, the S&P 500's equal weight ETF. It's popular for investors looking to hedge against cap weighting. How does Running Oak's portfolio compare to RSP?
Yeah, RSP is an excellent way to diversify from cap weighting. It's a good way to express uncertainty. The problem is, does anyone believe that all 500 companies in the S&P are created equally and that they're all attractive? I don't. I think that some are probably better investments and better companies than others. If you feel that way, then RSP, while it's better than some alternatives, is incomplete. At its heart, the simplicity of our strategy is we help clients focus on traits or qualities that are desirable. They're clearly desirable, such as, again, maximizing earnings growth, avoiding overvalued companies, or ideally investing in undervalued companies, investing in profitability, because making money is certainly a good thing. There's no arguing that. And maybe more importantly than what we help clients invest in is what we help them avoid, especially right now. So we help investors avoid companies that are unprofitable. We help our investors avoid companies that are wildly overvalued. Right now, the top 10 holdings in the S&P, the forward P is, I think, 20% higher than the forward P of the top 10 in the tech bubble. I mean, I thought we would never see anything like the tech bubble again, at least not for a while. But here we are. And maybe it continues, maybe it doesn't. But we help clients hedge against that and invest away from overvalued companies. We also help clients invest away from companies that have too much debt. As individuals, we know that if we take on too much debt, it's not going to be good. We've all probably made that mistake and regret it. And companies over the last decade have taken on more debt than any time in history, no matter how you measure it. And they didn't do it to build better companies that will be more profitable and that will be able to pay that interest and then pay that principal down and then deliver profits on top of that. They didn't do that. That's what they did in the past. In the last decade, they did not, because interest rates were so low. Instead, they mortgaged their futures to buy back stock. Buying back stock has some benefits as far as kind of shrinking share count, which, at least for those who are still invested, increases earnings per share. But you're adding a lot of risk. And now interest rates are a lot higher. So it was one thing to take on a bunch of debt when interest rates were lower. They're now higher. And at some point, companies have to refinance. That's the way debt works. Lenders only lend money for a certain period of time, and then you got to go back to the table. These companies are going to have to go back to the table. Interest rates are higher. If they roll that debt into higher interest rate debt, it's going to hurt profitability. If it hurts profitability, generally growth and profitability is an argument for higher PEs, that could bring down valuations. That won't be good. But the other thing is, as people, we tend to swing from one extreme to another. And again, in the last decade, companies took on more debt than any time in history just to buy back stock. There's a good chance you see the opposite, and companies have to sell stock to buy debt, which is not good for equity holders. So again, to kind of wrap all of that up, RSP is a great investment, certainly relative, in my opinion, in the long term versus cap-weighted S&P 500. But are all 500 companies in there created equally? Or would you rather invest in desirable ones versus less desirable ones? That's what we help clients do. And we do it in very simple, obvious manners, avoiding companies with too much debt, avoiding companies that are overvalued and should go down. And so it's basically just a more thoughtful RSP.
And so another way that you do it is focusing significantly on mid caps. Why do you think advisors should consider running Oak versus MDY or other passive mid cap exposures?
Yeah, so we invest in basically the upper mid cap to lower large. It's important to remember that line between mid and large is completely made up. The people that make up those lines, the multiple people, don't even agree on where that line is. But mid cap is a completely overlooked space, kind of like your middle child. Everybody focuses on the firstborn. They put all the pressure on him to deliver. And then the thirdborn, it's the baby, you got to do it. And the middle kid's just left to fend for themselves. But it's very much the case for mid cap. Most allocators that I talk to, and with the launch of our ETF a couple of years ago, I've had the opportunity to speak with many of the largest. They build portfolios basically in the same way. They start out with large cap growth, because if you didn't have a lot of large cap growth over the last decade, you got fired, which nobody wants. And then they diversify that with small cap. So you get this kind of barbell approach. Some use SMID as sort of a one-stop shop. Very few use pure mid. And so if you think of large cap growth balanced by small or SMID, it leaves this huge area between the middle of mid cap all the way up to basically the high end of large cap. So there's a lot of lip service that's paid toward the concentration risk in the S&P. What's overlooked is that same concentration risk exists in many, probably the majority of large cap growth portfolios, whether they're passive or active, partially because the only way to keep up over the last decade was to try to, just throw in the towel and participate. And so I use SCHG a lot, which is a Schwab large cap growth passive portfolio, as an example, because I see it so often. SCHG, last I looked, had almost 60% of its portfolio was invested in only 8 companies. So people think that they're investing, thinking they're getting this diversified exposure, that their risks are, somewhat being managed because you're not all in on a few companies. Turns out that's not the case. You actually have very little invested in almost the entirety of large cap, growth or core. And that's sort of where we sit. Now, that leaves mid cap completely underinvested. And why that really matters is when people invest in something, as we talked about earlier, that demand pushes the price up. Over the last decade, again, people have been piling into large cap growth, the same names, and then balancing with small. And as demand pushes those prices up, it pushes valuations up. Higher valuations imply lower potential return and higher risk. Neither of those we don't want those. Instead, if you invest where others aren't, which again, very few people are investing in mid cap, you get lower valuations because people are not driving those prices up, which implies higher potential upside and a margin of safety. So higher return, lower risk. That is an asymmetric risk return opportunity. That is what we all want. So the other thing is mid cap over the last 30 years has actually outperformed large. I think over the last 33 years, last I saw, mid had outperformed large by more than 60 basis points per year, which, ends up as an aggregate of 20% more return, which is great. That's what we want. Also, according to certain numbers, large is maybe 100% overvalued, whereas mid, according to certain numbers, is actually undervalued. So if history ever repeats itself and things just go back to what made sense historically, large could actually decline 50% while mid would have to go up. All those are great reasons to consider mid. Now, as far as MDY, though, again, going back to the RSP conversation, do we feel that every single company in, I think MDY is the S&P 400, I think. Do we feel that every single company in that index is created equally? Every single one is a great opportunity. I don't. I think some are great and some are less great. And we help clients, again, really focus on qualities that we can expect, or at least we would bet on delivering value over the long run, as well as avoid qualities such as too much debt, such as overvaluation, that are likely to destroy value and wealth. The other issue that I would also mention, and why I might favor, say, the Russell Midcap versus MDY, is MDY tends to be a little lower in the cap spectrum, right? It invests in smaller companies. And it just seems like it's going to be a difficult road, at least in the near term, for smaller companies. There's so many, because of interest rates being low, because of stimulus, there's so many zombie companies or companies that are barely hanging on that tend to be in that like lower mid and small cap area. Those are companies that you just don't want to invest in. Whereas as you invest in larger, and I love more entrepreneurial companies. I'm running a small business, but at this time, I think that the upper mid cap area provides, again, that asymmetry, higher return potential in lower risk.
There's probably lots of middle children out there watching who will enjoy this analogy. Before we wrap up, can you tell our viewers where they can go to learn more about you and your firm?
We have a brand new shiny website, runningoak.com. You can also go to runningoaketfs.com. I have very begrudgingly been more active on LinkedIn and social. So definitely you can check out my LinkedIn site. I've also very begrudgingly done more interviews like this. Luckily, it's less painful for many to watch than it used to be. So there's content out there that's maybe a little more targeted that might be beneficial. So reach out or check out any of those, and then also feel free to email me at seth@runningoak.com. I love talking stocks, love talking what's going on in the world. So feel free to reach out.
That's awesome. Well, thanks again for joining me, Seth. And thanks to everyone for watching. Be sure to like, share, and subscribe for more episodes of Lead Leg Live. I'm Melanie Schaefer. See you next time.